Hello everyone. Today we are talking about a very different topic and a topic which has impacted all of your lives, and you've been hearing about it here, there with your friends, government, news everywhere, but you are not aware exactly what they are trying to tell you. So I'll tell you today we are talking about taxation. Taxation across asset class. So just investing in the right stocks, investing in the right bonds are not enough. You need to make sure that you are invested in the asset class that makes the most sense. That makes the most sense in terms of the effective returns after taxation and are making sense in your financial journey. So today we will understand the taxation across different asset class, and we will try to understand how much we are paying to government for the different returns we are getting, be it interest or the capital gains. So stay tuned. Let's dive in. So the asset classes that we'll be covering today, first will be equity. In that we'll be talking about the futures and options incomes, direct equity, buy and sell, mutual funds and whatnot. Then the second one would be fixed income, something like fixed deposits and bond investments. And then there is a category real estate, because that's a very crucial one, because we buy, sell and give property on rent, but we are not aware exactly what is the taxation on that for sure. Now fourth, very important in the current times, you must have heard that gold has rallied to all-time high. So it is a very fundamentally good asset class right now, and we should know what is the taxation if we buy gold from different channels or the different platforms. And last but not least, crypto. It encompasses your digital investments, your cryptocurrency, your Bitcoin, your Ethereum, your Solana, and the other NFT related also. So we'll be covering these 5 asset classes in detail and what are the different tax brackets or tax applicable on these asset class. Let's dive in. So the very first one is equity. So in equity, we have 3 broad categories. The very first one is short-term capital gains. What we mean by that is any equity shareholding that you exit before 12 months period, then it is considered as short-term capital gains, and a 20% tax rate is applicable on your profit, on the total profit that you've earned in that entire year. Now moving on to long-term capital gains. So long-term capital gains is something if you hold a commodity or if you hold the equity stock, if you hold it for more than 12 months, then you are obliged to pay long-term capital gains. And currently the long-term capital gains in India stands at 12.5%. So if you are having a profit of 100 rupees in a year from your stock portfolio, and that is realized profit, the stocks that you've sold already, it's not the unrealized one. If it's just showing in your portfolio, you don't have to pay any taxes. It's just if you have bought a stock like 2 years back and then sold it now, then you are obliged to pay the taxes for the profit made from that stock in this current year. Next one is a tricky and interesting one. So any income that you've made through futures and options or intraday trading, and to an extent positional trading also, so that is considered as business income. So business income, what will happen? Whatever is the tax bracket that you lie in, if you are lying under the 5 lakh bracket, if you're lying under the 10 lakh bracket, whatever is the tax slab applicable to you based on the total income that you've generated in that year, the applicable tax will be calculated using your tax slab. So no STCG, no LTCG, it is pure business income, will be taxed as per your income tax slab. So that's the last category from equity, stocks and mutual funds. And same goes for equity mutual funds. So short-term capital gains and long-term capital gains is valid for the mutual funds as well. If it is a more than 65% of allocation is in equity class, then it is treated as equity mutual fund, and this will be the tax structure for those kind of mutual funds. Let's dive into the next asset class, which is fixed income. So the very first one is fixed deposits. On the fixed deposits, you give a fixed deposit to a bank, you keep a fixed deposit in a bank, and then they give you some interest corresponding to that. So that interest is fully taxable, and it is taxable as per your income tax slab. So based on the total income and the slab you fall in, the interest will be considered as income from other sources, and it will be treated as the overall income, and the tax will be applicable based on your income tax slab. Then the next asset class here would be the bonds. So this is a little bit tricky, so we'll try to understand one by one. The very first is bonds, there is an interest income associated. So if you are getting income on your bond investment, that interest income will be treated as income from other sources and it will be taxed as per your income tax slab rate. But then there is a capital gain. So if the bond is matured and then you sell it, then whatever the capital gain is, then it will be based on two categories. If it is a listed bond, then the consideration of STCG and LTCG is at 1 year. What I mean by that is, if you sell a listed bond within 1 year time frame, then it is considered as short-term capital gain and it will be taxed at your slab rate. But on the contrary, if you sell it after 1 year and that is a listed bond, then it is considered as long-term capital gain and it will be taxed at 20%. Now, coming to unlisted bonds, the tax rate for short-term capital gains is calculated by, if you sell it within 3-year time frame, an unlisted bond, then it is taxed at your tax slab rate. But if you sell it after 3 years time frame, so for unlisted bonds and sold after 3 years, then the tax applicable is just 10%. So this is a bit tricky. So feel free to take a screenshot of this for future reference. Now coming to the debt mutual fund. For the debt mutual funds, applicable for units purchased after April 23. So this is something latest and the most up-to-date version. So whatever is the profit that you're making on the debt mutual fund, it is taxed at as per your slab rate, as per whatever the slab that you're falling into. And mutual fund is categorized as debt if the percentage of debt instrument in that particular mutual fund is more than 65%. The next one is the real estate. You must be involved in some kind of real estate. You must be a tenant or a landlord, or you have a property or you have a flat of your own. If you acquire a property and sell it within 24 months time frame, then it is categorized as short-term capital gains. And how is it calculated? So whatever is the sale price minus the cost of acquisition, cost of improvement, or any other transfer expenses, that gives you total profit or the total capital gains from your property, and that capital gain from the property will be taxed as per your slab rate and it will be considered as your overall income tax slab rate. So don't confuse it like this will be different from your salary income or your business income. Whatever is the tax bracket that you fall into for that particular year, it will be taxed based on that bracket. So that is for short-term capital gains. Now for long-term capital gains, if the property was acquired before July 2024, then you have two options. One, you can go for 20% with indexation. Indexation here means it is the adjusted cost after adjusting for inflation using cost inflation index. So this is critical because the property that you bought like 5 years back must have been like a 1 CR, but right now it doesn't stand at the same value just because of the inflation impact also. So if the property is standing at 1.2 CR and you've sold it for 1.5 CR, then the effective profit is, from on the papers it might look like 50 lakh is the profit, but because of indexation benefits, the profit or the effective gains is just 30 lakh rupees. Whatever is the indexation value and whatever is the final value that you've sold the property for, the difference between that will be considered as the capital gain, and the tax liability only needs to be paid for that amount. So that is for the properties if you bought before July 23, 2024. And the other option that you have is you can go ahead with 12.5% without any indexation benefits, and you can just give a flat 12.5% on whatever is the gain that you are making on that particular property. But the latest schedule of income tax informs us that for the properties acquired after July 23, 2024, 12.5% tax is applicable without any indexation benefits. This is a tricky one because it might benefit some of you and it might be a loss for some of you based on the property you have, the inflation or the indexation benefits you were eligible for. But it is the hard reality, 12.5% without any indexation benefits. Now, the next one is rental income. The tax liability becomes only when, so you take the rent from the tenant, but you pay some interest on the capital used for that flat. You pay the interest on a loan that you've taken. And then there is the 30% standard deduction. So overall, the tax liability for rental income becomes little bit less than the actual rent. So basically, after standard deduction, and then after whatever is the interest that you're paying on capital, whatever is the leftover of the rent, that is something for which you have to pay the money to the government, and that is as per your tax slab rate. The next one, this is something that is all over the place these days because of geopolitical tensions and different issues going in the world. Gold has become a safe haven, and this is a good asset class that people are trusting these days, I would say. So the very first one is you can invest in sovereign gold bonds issued by the government. So the interest rate is around 2.5% per annum, and that is taxed as per your slab rate, as per your income tax slab rate. But at maturity, whatever is the capital gain that you're making, it is completely exempted. So fully exempted from any tax liability. So it becomes a very interesting proposition of investment because of the fact, first, gold is a safe investment as compared to other asset class. So SGB is something that you would like to introduce in your portfolio in some chunk for sure. Then there is physical gold, digital gold, gold ETFs, and mutual funds. So all of them fall under this almost the same category. But for the sake of clarity, I have highlighted as two separate line items. So there is STCG. If you buy and sell the same gold within 36 months, then you're obliged to pay short-term capital gains, which is as per your tax slab rate. And for the gold that you buy and sell after more than 36 months, then you're obliged to pay long-term capital gains. And for long-term capital gains, the effective tax rate is 20% with indexation. So you can avail the benefit of indexation specifically in gold asset class. Now coming to the last one, the crypto one. The crypto is very straightforward. So you have to pay government a flat 30% on all the profits that you're making in crypto. So no relaxation, nothing at all, just a flat 30% for all the profits that you're making. My personal opinion is that government is not favorable or not wanting to promote crypto assets in our country for sure, because the rules and regulations, the flat 30% with the following rules makes it very evident that the government does not want to promote this asset class as of now. Maybe in future, but definitely not now. So all the benefits that you could avail or benefited from the other asset class, be it gold, real estate or equity, those benefits are not present in crypto as of now. So that's it for today. So if you like the video, hit the subscribe button and like the video and share it with people who might need it and who are not aware of the different taxation policies or the different tax that they're paying on the asset class they are invested in.